Hey family, what's new? It's Stephanie Fauntleroy, your favorite enrolled agent. I'm going to tell you what's new. What's new is this One Big Beautiful Bill Act and how it's going to affect your taxes. So I want you to stay tuned so you can learn the top 10 things or ways that this bill is going to help or hurt you. Okay, so let's go ahead and jump right in. First of all, we know that most of these changes will take place for the tax year 2025, but some of them will be rolling into 2026. So let's talk about the ones that are going to be most important for you right now. So first of all, I know you've heard about it, no tax on tips. So you heard right. Under this bill, tipped workers may deduct $25,000 per year per taxpayer in tip income. So this deduction phases out once your modified adjusted gross income goes over $150,000 or $300,000 if you're married. So, great news for service workers, but income level does matter. So you can't be rolling in the dough thinking that you're going to benefit from this particular one. But it still really does cover a very wide group of people. And next, no tax on overtime pay. Up to $12,500 per taxpayer. So this same income phases out, $150,000 for the single person and $300,000 for the married filing joint couple. So if you're working extra hours to make ends meet, this one could really be big. Then we have the child tax credit increasing. Now, typically it doesn't increase every year. A lot of things do increase due to inflation. The child tax credit is increasing this year by $200 per qualifying child. So it's not a huge jump, but honestly, every dollar counts, especially for working families. So definitely make sure that you're looking to take advantage of that one. And then we have an extra deduction for our seniors that we care so much about. And I'm really glad to see the government catching up to how much we do really want to see our seniors comfortable, but also we want to see them retire. We want to see them feel like, they're able to have some money in the bank and do some savings so they don't have to work all the way up until they transition on. So there's going to be an increase to their standard deduction of $6,000. And that's going to actually be really tremendous. And in a moment, I'll show you what that looks like for the senior person or the senior couple, senior being over 65 years old. All right, so what you see here is going to be a tax scenario planning comparison, and this is a tax planning scenario for seniors. This is the actual couple, a client of mine, that has a total income, retirement income of $55,000. This is who this is made for, because we want these people to be able to retire comfortably, again, like I mentioned before. So we need to cut them some breaks. So originally, or pre One Big Beautiful Bill, their standard deduction was $32,300. It has been increased to $46,700. Okay, that's $6,000 per person. All right, so the taxable income drops to $9,200. The difference is huge. The tax on that was $2,377. Now it's $928, which results in a difference of almost $1,500 in their refund. Okay, so you can see here that this will be their refund. This was their refund with the old way, and this is their refund with the new way, $4,431. So that is really, really significant for our seniors. It's a significant savings for them, and they could see even other savings in some of the other tips that I'm going to tell you about here shortly. Okay, so one of the biggest things that I have been talking about for years, because since 2018, we lost the ability to deduct more than $10,000 in our state and local taxes. That's the SALT tax deduction. And because of that, we saw that high income earners in certain areas ended up having to owe a lot of money because they weren't able to fully deduct their SALT. So I spoke about this a little bit on a panel that I had the privilege of speaking on, the Minority Policy Summit, where I got a chance to kind of talk a little bit about how that loss affected some folks. And really look at the actual things that the taxpayers are paying, which is very high property taxes, but you can only deduct up to $10,000 of it on your tax return now. Okay, so now to give you a real live look at what this looks like, let's take another one of my clients and put it into a tax planning scenario. So here we have a client that has a total income, single person, of $136,000 roughly. Now this person has a business, they have other business income, other losses. They have a bunch of different things going on. But the main thing to pay attention to where this person is concerned is that their itemized deductions went up. Okay, so the itemized deduction for them was $37,000 at one time. It went up to $42,368, and that is because they were able to take their full state and local tax deduction of almost about $5,000 more, because where they were capped at $10,000 in the previous year, now they're able to take the whole $15,000 that they withheld through their job, that they paid in property taxes. So your state and local tax deduction can really be significant. And for this person, it resulted in them owing less. So now they didn't have a refund because, again, of all the other things that they have going on their return, but they did have a deduction, or a reduction rather, in what it was they owed, right? And it was almost $1,500, and that is also significant for a person. So that state and local tax, which I have been going on and on and on about, and literally praying that it would come back for people in higher earning states like metropolitan areas, states like California, states like New York, places like Washington, D.C., where I'm located. This can be really, really significant because we typically do have higher incomes because we have a higher cost of living, quite frankly. So this made a difference when people were doing their taxes after 2018. So to have that come back and have that capped at 40,000 is a really huge deal. So I'm excited for that one. That's one that's kind of near and dear to my heart, next to the senior standard deduction increase. Okay, so we've talked about quite a few things. We've talked about the no tax on tips. We've talked about the no tax on overtime pay. We talked about the child tax credit increasing. We talked about the extra deduction for seniors. We've talked about the SALT deduction. Now let's talk about another big one on the list that people have been talking about, and that is the vehicle interest deduction. And that's a big one. There are a lot of criteria you must meet. That car must be new. You must be under a certain dollar amount before it begins to phase out under $100,000. So there are some details as it relates to this one. And I think I'll do a deeper dive on another video on this one, because I think I want to make sure that everybody understands the criteria. It has to be a new vehicle. And one of the things I think it's really critical for people to understand is that the tax code is incentive based. All right. So this is a little bit of education for you. The tax code is incentive based. So typically when a government comes in and the government changes guard, they come in and they want to do things, that their constituents want, right? So they'll come in and make changes to the tax code that reflects basically promises that they made. So in this case, this particular government wants to get people to purchase things. They want to get people to buy things, and they're not really very focused on climate control and climate change. They do want to incentivize people to purchase new vehicles. They do want to incentivize people to purchase homes. They do want to incentivize people to get into business and to invest. So we see these things showing up in the tax code because this is what what this government supports. What we'll see go away, and these are not necessarily bad things, but they are different. What we'll see go away is things that were promoted, or things that were promoted by the previous administration. Like, we won't see the energy efficient credit for a home. We won't see the credits for electric vehicles or qualified electric vehicles, going forward. So those things will go away and the new things come forward. So this vehicle interest deduction that has come back, because we used to have it, is something that is an incentive for people to purchase new vehicles. And so there are details around how you can take advantage of that deduction. And we'll go into that a little bit later in another video. We also want to talk about the savings account for children, so the Trump account. So that's a big one too, and that's really interesting if you're looking to invest for your child. If that child is born after January 1st of 2025, they can qualify for the government to put $1,000 in a Trump account for them. So you just need to have your tax preparer fill out a form. Once that form is filled out, you'll get that account going. So you want to definitely do your research on what all of that entails. But as a parent, you can have your tax preparer go ahead and put that form 4547 on your tax return, so you can get that $1,000 and get that savings account going for your kids. So these are some pretty big things that are happening in this bill and in this new tax code for 2025 and forward. A lot of these things will phase out around 2030 unless they get picked back up. But for now, you should definitely look to take advantage of these incentives and these deductions, things like that are going on right now. So make sure you look into how these things affect you. Talk to your tax professional about how you can take advantage of everything that is new in the code, and please, definitely reach out and let us know if there's anything we can do to help you understand any of these things further, because I know it's a lot. I know I gave you a lot of information. I plan to give you more, so definitely hit the like and subscribe button and comment. Let me know if you have any ideas or thoughts or anything I can help you understand better. I definitely feel like education is the key to understanding how to plan your taxes and save money on your taxes. And at Baker Sachs, we believe knowledge is the real refund. Talk to you soon.